Welcome, performance managers. Welcome to Budgets and Forecasting, the latest teaching video in the performance management series. My name is Avo Schönbohm, and today we'll talk about budgeting. There's a running joke amongst controllers that controllers spend half of the year preparing the budget and the rest of the year trying to explain why the budget was not met. Okay, it's a joke, but it gives you a glimpse about the importance of budgeting within the overall performance management cycle, especially the operational performance cycle in management. The budget is the tool for managers. If you don't have a budget, you're not a manager. So budgeting is not just for bean counters, it is about the reality construction of the company for the next year. The learning objectives for this module are: first, understand the importance of planning and corporate budgeting. Yes, comprehend the logic of forecasting. Most of the companies do forecasting in one way or another, so it's important to understand how that works. Third, apply the logic of the master budget to a company. And the master budget is a social technology that is widely applied but rarely understood well. So we'll see how to do that, how to aggregate functional budgets into the master budget. And finally, 4, understand behavioral aspects of budgeting. Planning and control. So, why do we plan? And what does it mean? It involves developing objectives and preparing various budgets to achieve those objectives. So what does it mean? We are anticipating a certain future. We are breaking it down in different aspects and perspectives. And we're planning on these different fields so that we are prepared to meet the expectations of the future, of the situations that we have forecast. Planning is one thing. Unfortunately, the plan usually does not survive the contact with the first day of the new year, so we have to control. And controlling involves the steps to increase the likelihood that the objectives set while planning are attained. So how does it work? Even if our plan finds itself positioned into a reality where it's no longer fully fit, then we have to change the plan. We have to change the action. We have to redirect priorities to make sure that we can still achieve our goals. If there are significant variances from the plans, we have to take corrective actions, yes. And it's not bad, it's just part of the game. It's not bad to find out that our plan didn't work, but this is not an excuse for not taking the action to make sure that we're still achieving our goals. In the realm of the companies, the framework of budgeting is actually a very detailed and formalized way of dealing with planning. It's a detailed quantitative plan for acquiring and applying financial and other resources over a defined planning period. The planning period classically is a year, and the resources can be materials, human resources, and tangible or intangible assets. The act of preparing a budget is called budgeting, and the use of budgets to control an organization's activities is known as budgetary control. So we're not just creating a budget for having a budget, but there are intentions to steer and elicit behavior throughout the year. If we talk about the budget period, usually we have an operating budget that lasts for 1 year. That's classically the fiscal year, and the operational budget tries at the end to come up with a pro forma balance sheet and a pro forma income statement at the end of the year. So we try to anticipate how we will have performed within a 12-month period. Yes, so that's a 12-month period. There's also a continuous budget in several areas where there's a continuous 12-month period that's being planned. It's not necessarily in full details, but it's one way of having a rolling budget. In other areas, at least, we talk about a rolling forecast. Yes, this leads us to forecasting and how it's applied. So let's take the sales budget. And we see that there's a budget from January to December. Let's assume that there's a monthly detailed plan for how much we're going to sell. Let's assume that these are million euro terms, for example. And we'll find out that's an actual number. And the actual number deviates from the originally planned budget number. You see the delta in the third row. And yes, we had a forecast. So in January, of course, our forecast is our budget in total. And the forecast refers to what do we expect to see at the end of the year. There's a first quarter forecast. So in March, we find out, maybe the way we work will lead to a substantial drop in our final achievements. And so the first quarter forecast is a negative 190. Let's say that's still optimistic because we're almost 10% below budget, but okay. We see that the actuals are actually catching up a bit, and that in June, at the end of June, when the second quarter forecast is being prepared, there's slightly up edging of our forecast, and we are closer to the originally 200 envisaged. Not bad. The story continues, and at the end of September we work on our third quarter forecast, and hey, since we're actually now beyond, almost close to what we expected, that we say, okay, the third quarter forecast say yes, we will reach 200. At the end of the day it's 199, but you see this is on the monthly, or at least in this case on a quarterly basis, a more or less formal pause in the planning and control process, where you say the forecast is not necessarily what we plan to achieve. This tries to anticipate what we will probably achieve, given the situation at hand. The master budget is an operational planning tool. The term itself is a bit misleading, since it is not just one budget. It is an aggregated series of various different functional budgets or sub-budgets, which ultimately lead to a budgeted income statement, a budgeted balance sheet, and a budgeted cash statement. Some also call the sum of these pro forma statements the master budget. Everything starts with a sales budget. We have to make a substantiated claim about how many products and services we are going to sell, ideally with an indication when during the year. This is the foundation of the rest of the planning, the top line of our planning process. The sales budget determines our revenues and our cash income, but also the production level and therefore the full operating budget. The operating budget shows our operating activities for the year. In the case of an industrial company, this is a physical production process. In the case of a software or service company, the production of the software or the service. Since cost accounting is still very much focused on the logic of industrial companies, we'll follow the production logic. The sales budget feeds inventory and the production budget. At the end, we will decide how many products to produce when. With a fixed production budget, we can now decide on how much direct material to buy, how to plan the direct labor, and all the rest, which will be taken care of in the production overhead budget. In the production overhead budget, we will also determine the absorption rate for the following planning period. This will have an impact on the evaluation of the finished goods inventory in the budgeted balance sheet, and of course on the budget income or profit and loss statement. Most of the planning decisions of the operating budget will also have an impact on the cash budget. Apart from the operating budget, we also have the SG&A budget, the selling, general and administrative expense budget. There are many different individual budgets seemingly unrelated to the production processes. They will affect the cash budget and the pro forma P&L. The budgeted cash statement, the budgeted balance sheet and the budget profit and loss statement will be the final outcome of the planning process and used for the communication with the stakeholders. So this, in a nutshell, is the logic of the master budget. Now we'll have to start with the beginning balance. And the beginning balance is important because it provides us with all the important information for the rest of the planning period as far as assets and liabilities are concerned. So especially we'll have a look at the cash, the accounts receivables and the raw materials, but also the finished goods inventory. And if we look at the stockholders' equity and especially the current liabilities, this is also the starting points, and the accounts payable will also be taken into account. Additional information here that we'll have to take into account is raw materials in kilograms and finished goods inventory in cases. So the beginning balance can be taken from the end of the year balance from the last year. So we are seamlessly blend into the accounting cycles. The sales budget. The sales budget is the magic bullet. Having a good sales budget is like knowing already the numbers from the lottery of next week. It is a detailed schedule showing the expected sales for the budget period, and it's expressed in dollar, euro, or yen and unit terms of production. And how do we get to the final numbers? That's very, very messy. First of all, we talk to the salespeople and they will develop an opinion saying, oh, next year will be a complicated market only due to our special relationships to our key accounts. We will be able to barely maintain the level of sales from last year, but we probably have to go down a bit with the prices. Market research. Market research, we can even buy it, and there will be prognosis about the overall market development, which classically ends up with, in this particular market, we expect an overall increase in demand of 10%. We expect a slight increase in prices, and there are special segments in the markets that will be particularly prominent and develop particularly well. Then there are statistical models, so we can correlate all different kinds of factors. So there's, if you go into the literature, you will find out there's this red lipstick correlation that, for example, or that in times of economic crises, let's see how the Corona crisis works out, but in times of economic crises, red lipstick sales goes up. So there is a negative correlation between BEP growth and the sales of red lipstick. There are other correlations of the tendency to go to the hairdresser and the BEP growth. Of course, these are correlations and not causations, but it's quite interesting to see how this is working. And if we already know that our product our market is growing in line with industrial production, for example, of a certain country. There are huge think tanks that will plan industrial production for the next year. So we have a good basis to start our sales budget. It's very clear it won't be correct, but it might eventually give us a range so that we can under the year maybe also reassess our priorities, but it gives us a range of what to do. A competition and the increase in competition plays a role. If one of our key competitors goes bankrupt, this of course is a huge opportunity for us. If there's a new competitor coming, maybe a big Chinese player, that might be a problem for us, and our production our sales will suffer, and we will see the repercussions in our production budget as well. Changing tastes and incomes of customers might be an important thing. In times of crisis, people will become less spending on things that they don't need, business class flights, for example. And yes, and there are other things that we can do. So if we plan huge promotion and advertising campaigns, this hopefully has an impact on the budget, on the sales budget. So if we have a huge advertising campaign and we have a huge popularity of our popularity of our product in the media, this is of course having an impact on what's happening with the demand for our product. We don't know how much it costs and whether it's a good investment. That's a different story that you learn more about in marketing. Yes, after sales term offered, after sales services and credit terms offered may also play an important role here. Let's have a closer look at the sales budget of the Post AG. So they're budgeting for 4 different quarters. And yes, beer consumption varies with the seasons, and the winter quarter only has 20,000 cases to be sold, and the summer quarter, the third quarter, double the amount of cases. The retail price will be the same with 12.5 euros per case. Out of that, we can easily compute the total sales per quarter and the total sales per year, roughly 1.5 million euros. If we want to move from the sales budget to the cash budget, at least the expected cash revenues to come in, we have to move and see that not all the sales will be collected in the period of the sales. Indeed, only 90% are expected to be collected during the periods. That means there at the fringes something is happening, and we have to take care of that. And we also have to take care about the accounts receivables that are still on the balance sheet. So
The accounts receivables on the balance sheet will materialize in the following quarter. That means in the first quarter. And we see that 90% of the sales of the first quarter will also materialize in cash payments. So out of that, we can deduct that we have cash collections that vary slightly from the sales of the quarter. And overall, we are expecting total cash collections to be slightly superior to the total sales of the year. With the production budget, we are finally reaching the realm of the operational or operating budget. The production budget is prepared after the sales budget. The production budget lists the number of units that must be produced during each budget period to meet sales needs. And an important complication, we also want to provide for the desired ending inventory. The desired ending inventory is like a buffer between production and point of sales. So in case we have any problems with production, we will still be able to serve our customers. If capacity is a limiting factor, the company can subcontract, plan for overtime, and introduce shift work. These are short-term solutions to production shortages or bottlenecks. If we have long-term production bottlenecks, we should increase our capacity. That means additional machinery that we either hire or buy. But this takes longer time, and usually for 1 year a planning period, this has to be taken care of for the next period. So let's take a look at the production budget. The production budget tries to balance the difference between the budgeted sales per quarter and the required production. So the required production is the bottom line of our table, and we see that we start with the budgeted sales in cases, and we add the desired ending inventory of the finished goods. The definition is that we take 20% of next quarter's expected sales as ending inventory. That will give us an adequate buffer. So then we know how much is required at the end of the day, 27,000 cases in the first quarter. The good news is that we can deduct the opening inventory of finished goods, which is basically the production of last quarter's sales for ending inventory. So that was the buffer that's in our books and already on the shelves, and we can deduct that. So we come from 20,000 budgeted sales in cases to 22,500 required production. When we want to produce, we also need material. Therefore, we have the direct materials budget. The direct materials budget is prepared after computing the production requirements and preparing the production budget. The direct materials budget details the raw materials that must be purchased to fulfill the production requirements and to provide for adequate inventories. So far, so good. Actually, this can be quite complicated with tens of thousands of different material numbers, and therefore we have material requirement planning or enterprise resource systems. MRP systems or ERP systems. Actually, it's a quite complicated thing to source the materials needed. And we also have the management of all our suppliers, and this is much more complicated than is suggested by the direct materials budget. But right, this is an important step. How do we do that? We know that the required production in cases is 22,500 in the first quarter. We take that from the production budget. We know that we have raw materials needed per case in kilogram of 8, and therefore we understand how many kilograms we need for the first quarter. We already talked about desired ending inventory for finished goods. We have the same for raw materials. And in this case, we want to have 20% of next month production needs as inventory. So we have total needs of 222,750. We have 30,000 inventory already on the shelves, and therefore we understand what's the total number of raw materials to be purchased. There's a price of cost of raw material per kilogram, 8 cents per kilogram, and we have the cost of raw materials to be purchased. That's basically it, but unfortunately, in this case, it's also very easy, but unfortunately, it's not that easy. Maybe we need half a year to buy things, to order things. Maybe some of the items we order do not come in the right quality or at the right time. So there are many more complications in the purchasing process. But let's see, this is basically what we need, and the direct materials budget is a very important step and very important part of the series of budgets in the operating budget. Let's not forget labor and human resources. So to be able to produce, we also need manual labor in our case, and we know that we need 0.3 direct labor hours per case to be produced. So in total for the first quarter, we understand it's 6,750 direct labor hours that we need, and we have to pay 10 euros per direct labor hour. So we know that we have a lot. We know the quantity of labor hours and the cost of labor hours. Very important. Let's take a step back and see that direct labor cannot be put on the shelves, and we cannot just ask people to come and they will. So we have to plan that more carefully. We have to make sure that we have sufficient labor when we need it. We might be able to hire additional people, but this needs planning ahead. Also, human resources has feelings, so we have to deal with our employees carefully. If we plan with them in an erratic way, this will lead to feelings of insecurity, will lead to low morale and inefficiencies. The manufacturing overhead budget. The manufacturing overhead budget contains all manufacturing expenses that are not part of the direct material or labor budget. The information contained in this budget is used to compute the line item cost of goods sold of the master budget. We'll find that in our income statement at the end of the master budget. Further, the manufacturing overhead budget contains an overhead rate valid for the budgeting period, which is used to calculate the value of the budgeted ending inventory presented on the balance sheet. The budget is especially important as it contains a huge proportion of the overall budgeted expenditures of an entity. If we look into the details of the Post AG, we'll find out that, for example, to take the first quarter, we have a total budgeted direct labor hours number of 6,750 hours. We have a variable overhead rate of 2 euros, which means on every labor hour that is direct, we know some portion of non-direct labor will be affected. Like, for example, we have checking or preparing the machines that goes before the direct labor can work. Therefore, we have variable manufacturing overhead that is more or less variable, but with the production units, but not directly absorbable. And we have fixed manufacturing overhead of 40,000 euros. The fixed manufacturing overhead could be something like the rent, could be something like the salary of the plant manager. So the total manufacturing overhead per month would be 53,500. And yes, it is important to understand how much of that is depreciation. And the depreciation, especially of the machinery that will be part of the fixed manufacturing overhead, is not cash relevant. So it's important when we compute the cash budget that we do not take into account the depreciation expenses. So we can calculate the total manufacturing cost per each month and quarter, and finally the total year. And the total manufacturing overhead of 237,100 is a basis to spread this. No, but this is the basis. We need to spread this over the products that we have. So this is not a detailed teaching note on absorption costing, but one way of spreading these total manufacturing overheads would be to take the budgeted direct labor hours of 38,550, and we take the total manufacturing divided by the direct labor hours, and we know that for every direct labor hour that is spent on the production process, we have an additional 6.15 euros that will be automatically absorbed to buy the product. Yes, it's very clear that this predetermined overhead rate will not be completely consistent, but this is the rate that we agree on the beginning of the year, and we apply this rate throughout the year. So a little excursion would be to talk about over and under absorption at the end of the year, but this is more an accounting issue that we'll have to take care of at the end of each planning period and not at the beginning. Now we're able to calculate the unit production cost. This calculation is needed to determine the cost of goods sold on the budgeted income statement, but it also lets us know what amount to put on the balance sheet inventory account for unsold units. So let's see how to compute the unit product cost. We take direct materials. We know that it's 7.5 kilogram, and we have a price attached to that. So we know that the direct materials cost at 60 cents per case. We have direct labor, 0.3 hours per case. We know it's 10 euros per unit. That means we have 3 euros of direct labor coming on every case. We have manufacturing overhead. This manufacturing overhead is computed based on the number of direct labor. So it's 0.3 times the units, the same as for direct labor, and we multiply with the 6.15 absorption rate, and it gives us a 1.85 euros as manufacturing overhead that will be absorbed by the unit production cost. That is at the end 5.44 euros. So when we have this number, we can calculate the budgeted finished goods inventory. We planned with a finished goods inventory of 8,000 units, and we know that our production cost is 5.44 euros fully absorbed, and we know that the ending finished goods inventory like that will be evaluated and appear at the balance sheet, the pro forma balance sheet, or the planned balance sheet of 43,528 euros. The SG&A budget. The Selling and General Administrative Expense budget lists the budgeted expenses for areas other than manufacturing. In large organizations, this budget would be a compilation of many smaller individual budgets submitted by department heads and other people responsible for selling administrative expenses. For example, the marketing manager in a large organization would submit a budget detailing the advertising expenses for each budget period. So let's have a look at our Post AG. We know that there are several aspects here to look at. First of all, we can divide the SG&A expenses into variable and fixed selling and administrative expenses. Let's have a look at the variable expenses. The variable expenses per case are probably transportation costs. So we are bringing our cases to our customer. That would not be part of the production and cannot be put on a shelf. Therefore, it's a budgeted variable expense. In this case, we say it's 0.48 euro per case. And in total, we have 9,592 in quarter one. Then we have different budgeted fixed selling administrative expenses. We have advertising, we have the salary of the executives, we have insurance, property taxes, depreciation, and therefore a total budgeted fixed selling administrative expenses of 90,000 euros. Together with the budgeted variable expenses, we end up with 99,592 euros, out of which we know that there's a certain level of depreciation of 10,000 euros per quarter. Some of the cost lines only appear in 1 or 2 quarters. For example, insurance will be paid in the second and the third quarter, and the property taxes will be paid in the fourth quarter. But here you can see that our SG&A budget is quite substantial, almost 500,000 of the Post AG. So, having talked about the operational budget, the sales budget, and the SG&A budget, we can now talk about the final cash budget. And here we will start with the cash balance of the beginning of the quarter. Actually, this is the cash balance of last year's balance sheet, 250,000 euros. We know that there will be collections from the customers coming in of 315,000 euros in the first quarter. We've looked at that number in the sales budget, and we have total cash available. Out of that, we have to pay for direct materials and direct labor. We have to pay for the manufacturing overhead, our selling and administrative expenses. On top of that, there's some equipment that we want to purchase. This is more coming from the capital budget, but which we won't deal in this teaching note, but maybe in the investment teaching note. And we have to pay dividends to our shareholders of 25,000 euros a month. Then there's income tax to be paid, and we have total disbursements of 318,497 euros and some excess of cash because our total cash available, that means all our income, is more than our expenses. So far so good. We still believe that we want to borrow some money. So we expect that we want to borrow 120,000 euros, and that will end our cash balance with 366,503 euros. And then we go through the second quarter, because the cash balance of the ending of the first quarter will be the beginning of the second quarter. We do the same exercise and find out that, wow, yes, we end up with excess of cash of 456,886 in the second quarter. We'll still add additional 60,000 euros because the third quarter will be our most important quarter and working capital will be big. So we have to pay for that and invest into the working capital and get additional money. The third quarter then sees that we develop total cash available of more than 1 million, and cash disbursements are 385,000. We have a lot of cash left, and we can start paying back our debt. So in total we have 180,000 euros of debt, and we pay back 100,000 and pay dividends. Not dividends, we pay interest on it, and we do the same in the fourth quarter. So this cash budget is a detailed plan of when we are going to receive money and when we want to pay money. And this already includes something like a finance plan, when we want to borrow money and when we want to pay it back, and what amount of interest rates we will pay. The budgeted income statement can now be easily computed because we have all the data needed. We have the budgeted sales, we have the cost of goods sold. That means the total that we computed of 680,125. We have a gross margin. We have selling administrative expenses of 477,000. Therefore, we generate a net operating income of more than 400,000. With interest expenses and income tax to be paid, and can calculate a net income, a pro forma net income in our budgeted income statement. The same is true for the budgeted balance sheet. We now can compute all the necessary elements. We have a look at the depreciations. We know how much cash we will have at the end. We know how much accounts receivables will be there, and the raw materials and the finished goods inventory. All of that was planned along the line. Same is true for our retained earnings, because we also thought about our dividends. We have the accounts payables, and we have more information about how much raw material we have and how many cases we will have in stocks. So let's talk about the process of creating a participative budget. First, we communicate the details of the budget policies and guidelines to those responsible for preparing the budget. So we have to define the rules of the game. Then we have to determine the factor that restricts output. Usually this is the sales budget, but if production is the bottleneck, then maybe that would be the output restriction. Third, we would prepare the sales budget. We talked about how tricky this is and how foundational for the rest of the overall budgeting exercise. Then we prepare the budgets in initial preparation, and then all these numbers will be negotiated. So higher management will have to say, oh wow, you came up with a negative net income. This is not acceptable. Some will say, hey, we need to come up with profitable growth. So come back and do something to make sure that we increase our sales instead of stagnating. So there are a lot of political and as well business reasons to come up with different budgets than the initial budgets that were there. Maybe we're just planning ahead and see, oh, the costs will rise, our sales will not, and the prices in the sales process might eventually deteriorate. So this is a whole political process that stirs the changes in the processes in our production line, and so on and so on. So it's a very important negotiation that goes on, and higher management's job is here to make sure that the overall budget that is generated in the master budget is attractive for investors, is realistic. We coordinate and review the budgets, which is good, and then finally we end up with a final acceptance of the budgets at hand. This is a very important indication. Once everyone agreed on it, this can be presented to investors, this can be presented to banks, and it is a very important forecast and control mechanism. Performance managers, the end is nigh. This is the end of the budgets and forecasting teaching video. Budgeting is a very interesting and tedious process at the same time. Here, all the politics, all the strategizing, all the cost cutting, all the creativity can be seen. And at the end of the day, it's also a number crunching activity. So it's both. But performance managers are at the heart of facilitating this budget, and therefore they have to understand not only the numbers and the methodology, but also the performance areas on which these numbers depend. Thank you very much.